Well, thanks very much, Paul, and good evening, everybody. Before I get started, I want to make a recommendation that everyone go out and buy this book titled The Great Influenza by John M. Barry. It provides a lesson on what went right and what went wrong back in the 1918 1919 Spanish flu, and what a 2 year cycle of hope and despair and hope and despair from a global pandemic looks like, with obvious differences between now and then. But what hasn't changed over the century is human nature and our capacity to extrapolate the current situation into the future and the risks of policy missteps, which, like back then, we have seen in real time today. And I'll get into what I see happening in the here and now on the economy and the markets, and where I agree and where I disagree with the prevailing consensus and the market pricing. So at the outset, I'll just say that the way that I'm thinking about the current situation is that we've had a global economy hit by a massive exogenous shock in the form of the virus. It caused a draconian policy response in the form of unprecedented widespread economic shutdowns. That was followed by the reopening phase, creating some form of a V-shaped economic outcome, where the snapback was less robust than the initial drop-off was severe. So the recovery we saw in late spring and summer, as far as I'm concerned, is now in the rearview mirror, leaving most advanced economies around the world somewhere between 7% and 18% below the pre-shutdown levels of economic activity. The question now goes to how rapidly the clawback of pre-shutdown output levels is going to proceed. And what's clear from the data is that the initial V-shaped snapback is unsustainable. And in fact, I believe, and we saw it in the retail sales number today in the States, we are in the midst of a growth downshift right now. The only question goes to how much the downshift is going to be. So my view is that the lowflation world of secular stagnation that existed pre-COVID still exists now, except now there's the overlay of this exogenous economic shock that increases fragility, particularly where consumers and corporates are so highly indebted, like they are in the US and in Canada, and where downward demand shifts are greatest, like for small businesses and for travel and for leisure in particular. And how much of this is priced in remains to be seen. Second point I want to emphasize at the beginning is that it can't possibly be lost on anyone that what we had was a health crisis that morphed into an economic crisis and then somehow managed to morph into a financial crisis that was 10 times worse than anything we saw in the great financial crisis over a decade ago, and forced the Fed to probe the outer limits of monetary intervention. We just simply refuse to stop these cycles of redressing debt crises by adding more debt, which then merely compounds the adverse effects from the recession that is inevitable. And yet at the peak of the cycle, nobody ever seems to be prepared for one. And even in the household sector, while there was no bubble this time around in residential mortgages, that much is true, at least in the United States, there was clearly a huge bubble in autos, huge bubble in credit cards, huge bubble in student debt. And this is why it's going to be more like a depression, because what comes next is a secular change in attitudes towards credit and towards savings. I mean, seriously, over half of American households didn't have enough cash on hand to even get through 3 months of a job loss. And that's quite remarkable when you consider we went into this mess with a 50-year low unemployment rate of 3.5%. And not to mention the corporate sector, where for some reason the word liquidity became a dirty 9-letter word this past cycle. Now, every business has working capital they have to cover with a fraction of last year's cash flow. And this got me thinking about how the future will be one of treating savings as sacrosanct. So here's the future as I see it. I think we have to start bracing for I would say, a 6 to 18 month span where the economy virtually stalls out. That range is going to depend on the future policy response that we see, what happens on the COVID-19 and further spreads, and of course, what happens on the vaccine fronts. Corporate bankruptcies are going to accelerate as business owners run out of ways to keep their businesses open amid capacity constraints that's forced by the ongoing social distancing, which is a fact of life until a vaccine arrives, proves to be effective, and gets broadly distributed. Despite what you hear, that is not around the corner. That's going to weigh on hiring. It's going to weigh on the labor market. And what comes with that is more monetary policy easing and an even further disconnect between the financial economy and the real economy. And to quote what Leon Cooperman recently said, in quotes, he said, "Capitalism as we know it will likely be changed forever," end quote. And we remain in a world where probably the less you know about the economy, the better it is for your financial returns, because Uncle Sam has really taken things over. In other words, the way I would describe it is that we are witnessing one of the most impressive liquidity bubbles of all time. And fundamentals really don't count for much in this massive money creation environment or valuations. It's all about liquidity, or should I say excess liquidity. Now, let me just also confess to a belief that this recession was going to last quite a bit longer than it did. I know that I'm in good company, but there isn't a non-trivial chance that the economy could trip up again in the months ahead. But we came out of the eye of the hurricane, despite the fragility we have now. We did come out of the eye of the hurricane just about as fast as we entered it. And that's because the economy began to reopen due to this intense public pressure, especially in the States. And for a while, the big drop in the coronavirus case count, although we're seeing what's happening in Ontario right now, it's not really uniform. It's hardly perfect. But, you know, the clampdown on the economy did end early. And as I said, we also found out a lot more about this disease than we knew before. And that as bad as it is, this wasn't the Black Plague, as some had feared at the outset. And frankly, as horrible as the situation is, the deaths and the hospitalizations, they aren't nearly as catastrophic as what the experts were telling us back in March and April. So if you ask me, since we have a society, and I'm talking mostly about America, that is not nearly as subservient as is the case in most parts of Asia and Europe, and where people are willing to die to defend individual rights and civil liberties, you can't shut things down in the US like you can on that part of the world. So good luck ordering Americans around, as we found out, lesson learned. But I think the best that we can really hope for here is some sort of successful vaccine, however you want to define success. But I am starting to think that the base case scenario may end up being, as was the case with the Spanish flu, that we just are going to have to learn to live with the virus and live with it while we engage with each other personally and commercially. But the distancing itself and avoidance of crowds by themselves are going to impinge on economic activity, even if things do recover further. So my assumption is that we live with it. This is exactly what happened a century ago. And this means that a lot of things have to change. And don't get me wrong, this is no abdication of social responsibility. And there's going to be restrictions, just as there were when you think about it after 9/11. But I don't think we're going to be shutting down the economy in full again. I wouldn't say that's an ironclad guarantee, but I would say that if the back to school season triggers another wave, as we're seeing happening in Israel right now, at least partial shutdowns are probably going to happen. But I come back to this: until a vaccine comes, an effective one that boosts confidence, we're going to stay very cautious, or at least at the margin, a whole lot of folks are going to remain very cautious. And this in turn is going to have big implications on future growth, inflation, interest rates, and the capital markets in general. Now, the one thing we have to discuss is what happened beyond just the reopening phase, having occurred earlier than I would have thought. We have had policy support in the past 6 months that went way beyond anything I've ever seen or what I thought I would ever see. It's been stunning. The Fed has gone way beyond its role as a classic liquidity provider to, when you think about it, a market manipulator, and de facto is monetizing, when you think about it, both public and private sector debts. There is no comparison to 2008 and 09 when the Fed added AAA mortgages and treasuries to its balance sheet. I mean, this time it's across the risk spectrum. High yield bond ETFs, which I don't even know if this is legal, but the Fed is drawing off a loophole emergency measure it's never used before. But in tangible terms, the Fed has boosted the M2 money supply an unprecedented 23% this year. And what that comes to is an incredible $3 trillion of incremental liquidity from the monetary policy side. And then we had Uncle Sam, Congress, the White House, stimulate on the fiscal side by $2.3 trillion. And that's just so far. And that adds up to a massive $5.3 trillion of government support to combat a loss of GDP due to the pandemic and the lockdowns of $2.4 trillion. So you see what I'm saying here, that the policy medication has exceeded the pain by more than 2 to 1. So through the first half of the year, and I'm looking at the US right now, I'll get to Canada in a second. In the US, wages and salaries in aggregate plunged $400 billion. Yet, get this, personal incomes have soared $1.1 trillion. And you're thinking, well, how does that happen? Wages and salaries, they're down $400 billion, but personal income is up $1.1 trillion. How's this possible? Well, because government handouts to the personal sector skyrocketed by more than $1.5 trillion. So the point needs emphasizing. In the first recession ever, personal incomes went up 12% when wages fell 8% because of the 146% skyrocketing jump in government transfers to individuals. I mean, even Houdini would be jealous of this magic act if he were alive today. So personal income growth is actually more than double with the pandemic than it would have been without the pandemic, all because of Uncle Sam's generosity. And it's rather amazing when you think about it, how guilt and the necessity of preserving social stability can manage to drain the public purse as much has been the case this year. Now, I'd say good luck ever in draining the stimulus that people now believe is their birthright. And now we're learning in the United States that $1.5 trillion fiscal package is viewed as something that's skinny. That's incredible. We redefined what a bloated fiscal deficit is. So we'll see how that goes. No recession has ever seen a flood of government cash a month after a recession started. So I'll pose the question, what if we look back next year and realize that this is the good part of the economic recovery, and that the next chapter is that incomes fall when these government support programs ultimately end? Well, if they ever do. You know, the data in Canada are even more startling. I mean, here we are in Canada, first quarter GDP, negative 8.2% at an annual rate. Then the second quarter, negative 38.7% on GDP. Everybody's celebrating the third quarter is going to be wonderful. Yes, after a detonation, it's called a dead cat bounce. And even with the recovery in recent months, employment in Canada is still in the hole to the tune of over 1 million jobs, negative 8% annual rate on employment in the first 8 months of the year, and that includes all these wonderful data points in the past few months. So we actually have a situation where even with the rebound in job creation, the annualized trend in Canadian employment this year, that minus 8%, is double what we saw in the worst part of the 08-09 Great Recession. Just for some perspective on what this recovery really is about. It's about actually a government lifeline. I mean, think about it. These are the Canadian numbers. Canadian numbers. Labor income in Canada plunged 18% in the first half of the year, and yet personal disposable income expanded 26%. Why? Once again, because the increase in government transfers to the personal sector surged 324%. We've never seen numbers like this before. So labor income is down $115 billion. Total income is up $160 billion because of the $240 billion surge in Canadian government transfers. Now, Other forms of income fell, in case you're doing the arithmetic here. But the point is what the point is. The point is this. The point is that for the first time ever, a recession coincided with a 26% annualized increase in total personal disposable income. In other words, to showcase how the federal government has gone way beyond what was needed, total income in the personal sector in Canada is running 5 times faster with the pandemic and the lockdowns than if they had never happened at all. And this is how you can manufacture an artificial economy, and why it is very difficult for me to be bullish on the Canadian dollar, knowing just how inorganic this recovery has been. And it's with that in mind that I go back to what Jamie Dimon had to say a few weeks ago. And again, I quote, he said, "The word unprecedented is rarely used properly. This time it's being used properly. It's unprecedented what's going on around the world, and obviously COVID itself is a main attribute. The economy would be in shambles without the safety net of the CARES Act. In a normal recession, unemployment goes up, delinquencies go up, charge-offs go up, home prices go down. None of that's true here. Savings are up, incomes are up, home prices are up. So you will see the effect of this recession." He says, so you will see the effect of this recession. You're just not going to see it right away because of all the stimulus, end quote. Which then takes me to the bigger picture of this cycle and how things are running backwards to some extent. Hear me out on this. Instead of the normal economic recovery progression from a bad quarter to better, then to good, and then to a full recovery, maybe what we're doing is going from bad to better to bad again, and then we just stall with permanent job losses and consumer frugality, remembering that consumer spending is 70% of the economy. So it's true that we have up until lately seen surprisingly strong retail sales numbers, don't get me wrong, but it's on income that is nothing more than borrowed money from the government. So once again, here we are with personal incomes higher than pre-COVID-19, and 2 questions have to be asked and solved. Is this as good as it gets? And is this recovery backwards? And I say yes to both. Now, even if there's no agreement between the Democrats and the Republicans on fiscal policy, Jay Powell today made it clear that even with the Fed's forecast of inflation going to 2% by the end of 2023 and the unemployment rate dropping to 4%, he has pledged not to raise rates for the next 3.5 years. So this period of ever negative real interest rates is a signal to investors that the Fed is going to be blowing more asset bubbles as far as the eye can see. Then again, the Fed has always aimed its efforts to influence the real economy by its actions to either bolster or dampen the financial economy. So really, in some sense, nothing new here. The Fed's always used financial markets as its conduit, and the only difference this time has been the magnitude of the stimulus. And here, I thought along with so many others that the Fed headed into this recession with precious few policy bullets in the chamber, and boy, were we ever wrong. Now, let's talk about the Fed, since clearly the markets, both credit and equity, precious metals, commodities, currencies, everything is moving more on what's happening to real interest rates and the central bank balance sheet than what is happening with the economy. For the stock market, the correlation with the economy is almost non-existent over the past year. It really is all about the Fed. And the action on the stock market is being driven solely by this ever-expanding price-earnings multiple that is purely a derivative of Fed policy, which is why earnings and stock prices have basically divorced each other on a scale that we've never seen before. So behind the scenes, the way I see it is that the Federal Reserve is operating this bubble-making machinery. It's pumped trillions of dollars into the economy, expanding its own balance sheet to more than $7 trillion from $4 trillion at the start of the year. And this time around, as I said before, its asset purchases have included not only treasuries and mortgage-backed securities, but also investment-grade and high-yield bonds. We've never seen this before. And all this demand has served to lower interest rates to near zero, so it's created a scarce backdrop for income and greater comfort in taking on risk. So yes, we are in a financial bubble. My reasonings for how things have unfolded doesn't detract from that premise. I would say actually it's a fact that we are in a huge financial asset bubble. Yes, many companies are benefiting from the pandemic, but there are a lot of others who managed to hang on because of the long and generous arm of the Fed and Jay Powell's leave no zombie behind policy. So this market has become a momentum casino where Jay Powell is the blackjack dealer. The players get their chips for free. This is all about liquidity and pricing assets off de facto negative real interest rates. There is nothing really fundamental about this at all. This is why Leon Cooperman lamented that capitalism has gone on a long sabbatical, to which I say, let's hope it's not dead. Now, whether you think that's an extreme comment or not, there isn't any doubt that the financial markets are divorced from reality. So let's take a look at the corporate bond market and see how it's been distorted through all this Fed incursion and adventure. The average coupon right now in the high yield market, call it 5.4% against the long run norm of 8%, and spreads have collapsed to roughly 500 basis points against the long run average of 550 basis points. When you look at how the high yield market is positioned currently, it's priced for a 3.5% default rate at a time when we know for a fact that the default rate has crossed above 7% for the first time in a decade. And in fact, our statistical work shows the default rate hitting 12% in the next 6 months, which is something we have not seen since 2009. Then again, and I repeat, the federal government and the Fed have been adept here at breaking the markets in any relationship they have with the fundamentals. You look at the investment grade index, it's not only recouped all its recession loss, but the price now, on average, is trading 5% above the pre-pandemic peak. And what do you know? BlackRock, the advisor to the Fed on all matters of credit intervention, has, in quotes, a strategic overweight recommendation on investment grade bonds. Well, no kidding. So I'm speaking in general terms here, but I've been in the business long enough to see what is what. And the reality is that the Fed bailed out the investment grade and high yield markets that acted like idiots these past 10 years, handing out bad loans like Jim Carrey in the movie Yes Man. You know, where he gives out loans because the cult he joined says he must say yes to everything in life. He gives a loan to a woman starting a cake making shop where the cakes look like celebrities. He thinks the cake is Elvis, but it's supposed to be Alec Baldwin. But in fact, you look at how the junk bond market has been distorted through all this and how it's mispriced against the future default rates. But still, the mentality, just as is in the stock market, is that the Fed has your back. So I would just say that from my lens, high yield is not really high yield when the HYG ETF yields 5% to 6%, given the default wave that I see coming. And in fact, in the past, when the speculative grade default rate was 7%, investors were compensated with a 10% yield, not 5% plus. And I've said this many times before, it is not called high spread. It's called high yield. You need more yield to take on quasi-equity risk. So from where I come from, relative value becomes meaningless when the Fed is buying everything but equities. And the bottom line is that you have to have a hurdle rate for investments, and they have been totally distorted. So my view is that at a minimum, investment grade should be closer to 5-6% based on fundamentals, and non-investment grade should be at least 8% since it's quasi-equity. Oh, but you see, rates are zero. So investment grade is at 2%, high yield is 5 to 6%, and I truly find that amazing. Relative value against a broken price discovery system becomes the crutch upon which the weak rely to justify absurd behavior. But the Fed is making it hard to own risk assets right now with any degree of moral, intellectual, or economic-based grounding. I think it's totally mispriced. But the mantra, once again, is that the Fed has your back. But when you think about it, spreads in a zero-rate Fed-induced rally basically ultimately become irrelevant. You need to price absolute risk. And absolute yields, in my opinion, are stupidly low right now. So I would say that there simply is not that much out there for me to identify as having intrinsic value or alluring risk-reward attributes. All I can say is that every financial decision we make has to take into consideration that the Fed is in the game, distorting risk markets on a scale we've never seen before. It's making a mockery of capitalism and bailing out bad actors in the name of the greater good. but everybody seems to like it because everybody is getting rich. And as Chuck Prince famously said in the summer of 2007, you got to stay at the dance till the music stops. Fine. Now, I want to turn to this inflation debate. I've said repeatedly that stagflation is in our future, but you really don't want to be crazy early either. At this stage, it's like talking about dessert while we're still eating the appetizer. I think it's important to remember that inflation and deflation are a process. They're not a data point in time. It's not like pricing trends in the economy shift on a dime. It takes years. It's a race between watching grass grow and paint dry. Now, at some point, the increasingly inelastic aggregate supply curve is going to dominate. And I'm meaning here that the cost impacts from weaker productivity growth, increased government regulation, the localization of global supply chains, and a depletion in the pool of available workers, all this is going to conspire to drag the supply side non-inflationary growth potential for the economy lower over time. I get it. At the same time, I think it's important that we don't extrapolate the latest inflation data into the future because there's a ton of noise in the numbers representing a wild swing from the unprecedented discounting during the lockdowns when many companies weren't even able to sell anything at any price. So for the time being, the detonation on the demand side has just left too far of a gap between demand and supply, in my opinion, to be worried about inflation. We have an unemployment rate of over 10%. We have 1 of every 7 Americans is either unemployed or underemployed, and a third of industrial capacity is sitting idle. These are not the ingredients for an inflationary process, at least over the near term. So that's something we just want to put out there that, and I'll talk more about that later on, that we may get an inflationary experience a few years from now. It's worth being aware that we could get into a situation where from the supply side, inflation ends up coming back. But I think that for the time being, for the next couple of years, deflation risks are going to trump inflation risks. So I would say that, from a 1,000 feet up in the air, what I've gleaned from the data is how people's spending habits and their willingness to engage in credit have gone through a real secular shift here towards prudence and frugality. And it's amazing to me to even look at the US right now and see that the savings rate is 17%. So even though we've had this GDP spree and the better tone to retail sales, about half of the largesse that the government gave to the personal sector has actually gone into savings. And the one thing that's happening that's really caught my eye in the past several months is that households in the United States are actually paying down their credit card balances at a rate that I've never seen before. And in fact, in the past 6 months, households in the US have actually reduced their revolving credit lines by an 18% annual rate. I mean, how unpatriotic is that? But once again, when I talked about a depression before, I was talking about how this particular shock is going to create a fundamental shift in attitudes. And one of those attitudes is going to be towards credit and towards balance sheets. And that is going to be inherently, over the near term, disinflationary. People like to talk about, well, look what lumber's done, look what copper's done, look what commodities have done. They're clearly in an inflationary mode. But the reality is that the link between commodities and inflation in what is definitely a service sector driven economy is a very weak link. Now, I used that word before. I mentioned the word depression. And I've gone on record and stated that we are in a depression, not a recession, but a depression. And I think the dynamics of a depression are different than they are in a recession because depressions invoke a secular change in behavior. Classic business cycle recessions basically are forgotten about within a year after they end. At a minimum, depressions entail a prolonged period of weak economic growth, widespread excess capacity, and deflationary pressure, and a wave of bankruptcies. So I think the best case outcome is going to be something close to an L-shaped or backward J-shaped recovery. I think it's going to be a painfully slow, multi-year, grinded out jobless recovery that's going to be made possible really only by continued and constant support from gaping fiscal deficits and central bank liquidity. And again, to repeat, when you're drawing out the probability of all possible outcomes, I think that's the best possible case. And then we have to consider, when we get to the other side, the massive government debts that we've built up. How is that, along with these bloated central bank balance sheets, how are they going to get dealt with? Will the debt get monetized? Will they not get monetized? So I would say that what the world looks like when the crisis ends is truly anyone's guess. But I will say with 100% clarity that it's going to look a lot different than it did before. We're not going back to anything that is normal or quasi-normal. And it's not just a question over government policy and taxation, but at the individual level, months of isolation, distancing, fear of a return of the pandemic are going to fundamentally alter lifestyles and will have a profound influence, not just on the way we live, but on how we conduct ourselves in our personal lives and in our business lives. And you just have to consider how the world has changed in the past 6 months. Social distancing, even with the reopening, that's now the rule. And working from home is encouraged, as I'm doing. Movie theaters are half empty. Attending school now means opening up a laptop at a home for many students. Companies that bring us a taste of our previous lives, like Zoom, which has gone, think of Zoom, which has gone from this business-centric obscurity to widespread adoption to a work-at-home reality. The pandemic has resulted in a company like Peloton having its stationary bikes do what? Replace gym memberships. And then you have the shares of tech titans like Apple, Microsoft, Amazon, Facebook, Alphabet. They've risen sharply because the businesses are growing in today's world. Bigger is better in today's world. And investors see that in a recession, the revenues of these tech giants are up 15%, while sales in the rest of the market are down 5%. It's really incredible. The margins of the Fab 5 tech stocks in 2020, it's an incredible 29%. So, in some perverse sense, these companies have actually benefited from the pandemic. All these tech titans also have net cash. So that implies to investors little balance sheet risk. And this is what investors are paying up for. So frankly, I do have concerns over valuations. So some of the froth has been coming off in the past couple of weeks. I have concerns over the bizarre, and I would actually say dangerous retail trading in the options market that's recently accounted for a record share of total trading activity. This is unheard of and speaks to an unstable market structure. So yes, these are big concerns. But what we do know just based on math is that ultra low interest rates have boosted the valuations of companies expected to earn the bulk of their profits in the future, sometimes years down the road. So when discounted back to the present, far off cash flows are worth more today than they are in a higher interest rate world. That's pure math. And that calculation has helped lift growth stocks to records, even as earnings expectations have come way down because of the pandemic and the lockdowns. So the investment community is paying more for duration today than they ever have in history. But since we can anticipate rates to stay low for years to come, this valuation driver becomes the dominant issue that's going to be driving the market and prospective returns for a long period of time. This is exactly why growth investing has trounced value for much of the past decade, even before the pandemic. So ultimately, the growth versus value decision depends on what the world will look like once COVID-19 is in the rearview mirror. But even if we get a vaccine, even if we return to that pre-COVID world, when you think about it, it actually means a return to what? A return to a slow growth, low interest rate, low inflation world, which means growth will still probably remain the place to be because they are the longest duration stocks in the equity market. For cyclicals and value stocks to work, you need faster, sustainable global economic growth. You need real inflation. You need higher interest rates. And there's been talk of that lately in the marketplace, I know, but so far it's a trade. It's not a trend, at least not yet anyways. So as far as the future is concerned, I'd say at least the near to intermediate term is one in which working from home is certainly going to be a more dominant force with obvious negative implications for commercial real estate, but positive implications for internet infrastructure, computer hardware, video conferencing like we're doing right now. And at the same time, urban working and living will undergo a profound shift. And there's also a secular change, a much greater awareness coming out of this period of history beyond just hygiene, but also a much greater appreciation for space, as in open space. So there's going to be a sharp reduction in travel to work, travel in general. Nothing here that's very good news for the auto or office real estate sectors, that's for sure. But there are bullish themes here that emerge. And I said before, as we go into an era of frugality and elevated personal savings rates, this is already starting, people are going to focus on what they need, not what they want. So anything related to e-commerce, cloud services, wiring up your home to become your new office, this is a budding new secular growth phase. Delivery services have now become an essential, so there's a budding bull market right there for Amazon, which is so obvious. And I would add any business model that copies it. I would tack on grocery chains with online services, come out of this as a big winner. So the shifting behavior that's already taking place tells me to focus on consumer staples and other areas of the market, healthcare, and even big tech that have become essentials. Microsoft has become a utility. I would say one could argue that Amazon's become a utility. I'd say one could argue that Google has become a utility. And it's apparent to me that you want to have exposure to healthcare because this clearly is an underinvested area and will, without a shadow of a doubt, become less regulated in the future, no matter who takes the White House in November. There's other ways to hedge and diversify. There's segments of the REITs that I do like, not on the commercial sector, but I'd say industrial healthcare REITs that benefit from the Amazon effect. I think that those are investable areas of the market. I think that sustained uber low interest rates make their stable yield more attractive, and the cap rates are going to remain lower for longer. In any event, the major theme that I want to talk about in that respect is that we all have to become increasingly thematic and thoughtful in our decision making, more selective than normal, because the stock market and financial assets in general have become nothing more than a casino with no more true price discovery or risk assessment. We have a Fed that's basically created a one-sided heads you win, tails we bail you out psychology, and I don't see that going away anytime soon. And so that brings me then to one of my key investment ideas for the current state of the world, which is gold, as in physical gold, which is a very good hedge against the instability that the extremes of deflation and inflation bring. If there's deflation, interest rates remain low, they could go negative, making the opportunity cost of holding gold or precious metals in general nil. If there is inflation, well, gold is going to do very well as a store of value. And lastly, all this central bank alchemy has led to ever increasingly unstable markets, and gold will do well against that backdrop. And we also have to keep in mind, and look, I've been bullish on gold and gold mining stocks for the past number of years. In 2020, this became my highest conviction call, if for any other reason, that when you think of gold and how it's trading as a currency, not as a commodity, as a currency that has no government's liability, and its production growth runs at a pretty reliable and constant 1% annual rate. Whereas when you look at the production of money right now globally, it's running closer to 20%. 20% money growth, 1% increase in gold production. It's pretty obvious what the relative supply shifts are going to mean for gold over time. And the best thing about the correction we've seen in gold in the past couple of weeks is that at least it's taken some of the froth out of the market. That's what every bull market needs for its sustenance. But as I said before, the beautiful thing about gold is that it is not a liability that a central bank can simply have forgiven. It's not a currency that can simply be printed by government fiat. So that's the point that I want to make right here and right now. I also want to finish off talking about the bond market. I've got to say that a 1.4% long bond yield in the United States, and this is definitely a rare view. I consider 1.4% 30-year Treasury yields in the United States as a bargain. When you look at it relative to gilts, UK gilts at 0.8, JGBs at 0.6, German bonds are at 0. So as for bonds, I actually remain a big fan of what I call the convergence trade, as in US Treasury yields catching down to the rest of the world instead of the other way around. And there are people who say, what idiot would buy long bonds at such a low yield level? And yes, these are the same people who asked the same question last December when the yield on a 30-year T-bond was 100 basis points higher than it is today at 2.4%. So the answer hasn't changed. The idiot who wanted a 25% return on his or her portfolio is the idiot who bought long bonds at the end of last year. You aren't buying bonds today for the yield. You're buying it for the price appreciation. And the price appreciation in the Treasury market has accounted for 90% of the total return year to date. So everybody seems to know what the S&P has done year to date. They know what the NASDAQ's done year to date. They know what the TSX has done year to date. Nobody ever talks about the fact that the 30-year Treasury bond has delivered a 25% net positive return through the first 8 months of this year. Now imagine if this 1.4% yield on the U.S. long bond were to converge on, say, where they are in the U.K. Well, the total return in the bond market in the long end would be 18%. What if we ever converge with Japan? Aren't we all becoming Japanese? Yes, we're all turning Japanese. And the Europeans turned Japanese a while ago. The U.S. is going to turn Japanese. And if we go to a Japanese 0.6% long bond yield from 2.4, guess what? That's a total return of 24%. Then what if the long bond goes to zero, where it is in Germany? Most people don't know that the long bond in Germany is zero. Well, the total return would be 42%. So in any event, Warren Buffett's recent move to pare his holdings of U.S. bank stocks and move into Barrick isn't a sign, as the headlines are telling you, that the Oracle is no longer betting on America. The shift is more about a bet on nominal interest rates staying ultra low and real interest rates over time going more negative. And there's no asset class that benefits more from that than physical gold and the gold mining stocks and long duration, high quality bonds that would benefit from the cost to carry. That's going to remain extremely low. So I want to stress here, once again, that I do believe that you can build a strong case that inflation or stagflation comes back, but I think it's going to be at least 2 or 3 years before that happens. I can see a world where we're going to have more nationalism, protectionism, populism, isolationism, dare I say socialism. So we can see in the future from a cost push government regulation standpoint that stagflation or even inflation returns. But what I'm going to say, I'm very sensitive to this view that it's probably at least 2 to 3 years away. It is not around the corner. But in the interim, I'm going to be watching money velocity and the output gap for scientists want to pull the plug on my call on lowflation, as well as productivity, labor costs, what the labor force participation rate does. I have a complete checklist for when to start calling for a true inflation cycle. But right now, I think what we've been seeing is just a lot of noise in the data. So time is on our side. My current expectation is that the inflation or stagflation story is at least 2 to 3 years away, but I will let the data dictate any shift in my view on this secular trend and not before. And until we get the sustained inflation and rising interest rates, and I emphasize the word sustained, the key to investment success will be this: long duration in your portfolio. This is why growth stocks and real estate and long bonds have been good places to be, and to barbell that with gold, which is the ultimate insurance against what is a highly uncertain and likely unstable economic and political future. Anyways, I'm a little out of breath, so I'm going to leave it there and entertain any questions from the group.
So if you have questions that you want to pose to David, you can raise your hand and I can unmute you, or you can send them to me via chat. I do have one question that came in actually via the Evite message, and bear with me, David. Hi, Scott. I have a question I'd like you to ask David. My question is, what strategies can you suggest for preserving our capital as central banks print money with abandon? Is crypto an option or gold?
Well, I just concluded with that. I think I answered the question in my conclusion. Yeah, yes, I think that I think crypto is a. I think there is room for crypto in the portfolio. The answer is yes. The reason I prefer gold is it's just a lot less volatile. But I think that what I've been advocating is, so long as inflation does not come back, and I don't think inflation is going to come back for an extended period of time. The Fed's already told you that they're keeping interest rates at the floor for at least the next 3 years. So, I think that I'd rather buy these growth stocks. I mean, great companies. These are not the pets.com of 2000, but I think that they have massively inflated valuations. I'd like to come into the growth stocks again at better valuation levels. but I would sooner be in growth stocks than value stocks. I understand that the banks are trading extremely cheaply, but they have no earnings visibility, and zero interest rates, as far as the eye can see, is anathema to the banks. But it's going to be very good for anything that's long duration. Preserve the capital, yes. So I'd say have the bond bullion barbell. And if you're in the equity market, focus on growth. And growth doesn't just mean the large cap S&P stocks. You got better valuations in the small caps and mid caps. And actually, you can go and get growth stocks in Asia right now at much better multiples. People don't tend to talk about some of the darlings overseas, but Korea has been one of the best performing stock markets here to date. You don't usually hear that on CNBC. But I'd say you don't have to stay localized in the U.S., although they tend to have some of the best companies. But you want to have a focus on growth in the stock market. That's the long duration play and long duration in your bonds, and have a as large a share as you can tolerate in gold and gold mining stocks. And I would say derivatives of that. I mean, you could argue, platinum and palladium, but also I would say crypto would fit in that as well.
Hey, David, I have a question, but one just popped in on the chat. What will it take to deflate the Toronto housing market, in your opinion?
Well, I think that we're going to be seeing that over the next several years, because the one thing that's going to come out of this is a reduction in global immigration flows. That's one of the results of this pandemic. So it means that real estate markets that relied heavily on international migration inflows, and you can include Vancouver in there as well, lesser extent Montreal, they'll be vulnerable. So I wouldn't be extrapolating these past couple of months. Things were shut down in February and March, in April, and then we had the spring selling season in real estate, really artificially inflating the numbers in the real estate side. My sense is that the immigration side is going to play a very big role in depressing demand. It doesn't mean that prices are going to crater, but it does mean that we're going to have weakness on the demand side. That's going to play into reduced prices. I'm not at all bullish on residential real estate because of that, principally. And also, even though we have low interest rates, which of course, housing is a long duration asset, benefits from low interest rates, I get a sense that it's not the cost of credit that matters. It's going to be the availability. And the banks are going to be tightening up their credit. They've already started. So I would expect that mortgage credit tightness, reduced immigration inflows, is going to create a challenge for the housing markets, especially in Toronto, Vancouver, for the next several years.
That's a good point. It is a long duration asset and the rates are low, and there are alternative lenders out there as well. Another question just popped up in the chat. A question designed from RMC. What are the prospects for the North American economy depending on who is elected? So maybe talk about the election both from the on all three parts of the government.
Well, we're talking about the U.S. or the U.S. and Canada here?
I think the U.S. Well, right. You could mention Canada.
Well, I know we don't know. Well, we don't know if it's going to be an election in Canada, but I'll probably show my true political colors if I wade into that. I think, speaking of Canada, and one of the reasons why I'm not bullish on the Canadian dollar at all is I think we're going into a slippery slope, like father, like son, of credit downgrades in the future. I think we're going to be locked in. We've already lost our AAA status to one rating agency. That process has just started. We're going to be locked into structural deficits as far as the eye can see. In Canada, we are not the reserve currency. In any event, I'd say as far as the U.S. is concerned, look, it's really hard to say because, Biden can win, but will the Senate also flip? So it also depends on, will it be one party rule or not? I think that, in my opinion, I think a Trump victory would be seen as better for the markets. And it's hard to say, will it be better for the economy? That's really hard to say. It'll be better for the markets if Trump wins, only because he's not really going to do a whole heck of a lot. But we know that Biden has been pushed to the left. Now, He's not Bernie Sanders. I think that's probably a good thing. My kids don't agree with me on that, but I think that Biden is going to be raising corporate tax rates. I think he'll be raising capital gains tax rates. He's going to be raising taxes on foreign income more broadly, which is actually going to hurt the tech stocks. So taxation, actually, the odds, I mean, people will say, well, who would raise taxes in this environment? Maybe he doesn't do it right away. It'd be suicidal. But we're always talking about, pricing and risks. So you think about it, the risks of a higher tax regime in the United States, much higher under the Democrats. Their belief is they want to redistribute income. So it means that top marginal rates are going to go up. And then we don't know whether or not the modern monetary theorists end up taking over more control and we end up monetizing the debts, which means that maybe we get an earlier return to inflation under the Democrats and under the Republicans. These are the sorts of things that I'm writing about these days. For the economy, it's very tough to say. And remember, I said that the markets and the economy become divorced from each other. But I would only say that risk appetite will do better under Trump than under Biden. It's just a matter of magnitude.
One more in the chat. Wouldn't the Canadian government be crazy not to follow the US in throwing money at the recession pandemic? If things go bad in 5 to 10 years, does it matter if Canada has a 200% debt to GDP if the US does as well? So it's sort of a race to the bottom, if you will, or higher debt levels.
It's a great question. Well, you see, we are not the United States. Okay, we are not the most powerful nation on earth. We don't have the world's most powerful army. We don't actually, we're not the reserve currency. So, we just can't print money with a free printing press like the Fed can. We are a small open economy. I don't know if you've taken a look. We just got the numbers today for Canada for July. The foreign investment numbers into the Canadian markets. Foreign investors the past few months have been actually reducing their exposure to Canadian securities, both federal government bonds and equities. In fact, in the past 10 months, foreign investors have reduced their holdings of Canadian equities $37 billion. That's only happened once before, and that was in late 07, early 08. So I got news for you. Foreign investors are already telling you their feeling towards where government policy is going in Canada. The U.S., the bottom line is that they can get away with it a lot more than we can. They're just a more powerful country, and they're just a lot wealthier. So to draw the comparison, Canada-U.S., I think that we have to be very cautious about doing that. Now, in both countries, here's the problem. What are we doing? What are we doing? Like, are we going to continue to have fiscal policy that involves, it's not even stimulus. It's not stimulus. It's income support. So how long are we going to do this for? I think that, we're going to be left with structurally high unemployment. The easy part of this recovery is over. In both countries, we're probably going to have 6 million people in the US permanently unemployed. And we're going to have probably in Canada 1 million people permanently unemployed. What are we going to do? Are we going to have a government that's going to turn the pandemic into a permanent welfare system? We have to get these people back to work. So, what I would say is, yes, I'm not saying we shouldn't run fiscal deficits, but you see, these personal income transfers keep you whole, but they don't teach you anything. You're not working. The key is for fiscal policy in both countries is, what is the strategy to get these people back to work? Where is the infrastructure? How long are we going to wait for the infrastructure, whether it's in cyber or whether it's in green energy or whether it's in telecom or whether it's in old economy bricks and mortar? Maybe what we have to do is take a feather out of FDR's cap. Look, the New Deal in the 30s was a funky deal. It's a funky deal, but I got news for you. FDR did not pay people to stay out of work. They raised deficits to put people to work. And when you think of all the things that are still around today that were built in the 1930s under the New Deal infrastructure that created employment. I mean, we're talking about the Lincoln Tunnel. We're talking about the Golden Gate Bridge. We're talking about Route 66. We're talking about the Hoover Dam. We're talking about the waterway dams and infrastructure in northern Pennsylvania and Michigan. All this stuff is still around today. Had a huge productivity payback. Huge productivity payback. Nothing says that the public sector can't invest and earn a rate of return if they're smart about it. And I got news for you. FDR, by the way, in the New Deal, the Great Depression, FDR never ran, he never ran a deficit over 7.5% of GDP. The US were already at 15% going to 20, and we're already at 20% in Canada. FDR in the Great Depression never ran a deficit over 7.5% of GDP, and he never ran the debt more than 40% of GDP. The US is already at 100. So it's interesting is that 5 years after the New Deal, the productivity payback was so great that the US government by 1937 was back in fiscal balance. So, you know, that would make Arthur Laffer smile, because that is truly supply side fiscal policy economics. It paid for itself and then some. So I wouldn't call, so when people tell me, yes, should the government be doing this? Hopefully the government is sitting down, taking a long-term view beyond just income replacement. There's going to be a time we won't be able to afford it. The key is going to be, how do we get these people back to work instead of paying them to not work? That's called creativity. That's actually what I'm hoping, and maybe it's a hope and a prayer when we get the throne speech on September 23rd. Hope and a prayer, but we need real stimulus and real infrastructure, and I cannot believe 5 months after the shock, we're still just talking about the fiscal side as being income transfers. That's not the solution.
Well, the fellow who asked that question, another former Merrill colleague, just sort of made a statement here. Guaranteed or basic income is now going to become a reality. You know, and you kind of mentioned that, and then I think the other answer might be monetary policy, or modern monetary policy theory as well, i.e. this debt will never be paid back, never.
The debt will not be paid back. And I've written reports on the end game, and the end game is called the debt jubilee. So the end game will be debt monetization. And it's going to have to be global. It can't just be the US or the dollar will collapse. But I think and it's been done before. It wouldn't be the first time. And that's why gold will be a great hedge, or real assets will be a great hedge in that environment. But if we go the route of MMT, I mean, in real terms, we're talking about outright debt monetization. You know, I don't know what the ceiling is going to be on gold. You're just going to wish from where we are today that you had it in your portfolio. That will be very inflationary. When the Fed loses control of the monetary base, the inflation will come back. Got to stay on guard for that, especially if the Democrats win.
David, I'm looking at the clock. It's 7:10. I don't think we have any more questions. So I would like to thank you and your team for being our guest host for our 5th anniversary, or virtual anniversary celebration. I want to thank our clients, friends, family who have joined today as well. And I would say to everybody that's on the call, 2 things. We will send out a link, a recorded link of this call. We also have our new website is a work in progress that will be rolled out shortly. And finally, if anyone on the call is interested in a 30-day free trial for David's research, Rosenberg research, we'll send out that with a link tomorrow. Marcel Alls is in charge of that, and you can get him at MAULLS@rosenbergresearch.com. Rosie, thank you again. That was great.
Next time in person.
Yeah, we would look forward to that too, and we were happy to buy people drinks and a bit of food. Thank you, everyone.